Ladies and gentlemen, please welcome your moderator, senior columnist at the Wall Street Journal, James Mackintosh.
Thank you. That's what we're talking about. Now it's clear. Hello, everyone. I'm James Mackintosh. We've got a great panel for you today. I thought just before we start, for those of you who were wondering about the title, we've got RiskFree Return or Return-Free Risk. And you might not know the history of this, but the return-free risk was a phrase that's been blatantly stolen from Jim Grant, Grant's Interest Rate Observer, who's a great journalist. But he highlighted this as the danger that people don't really recognize in government bonds. And last year gave us the perfect example of this. Back in the summer of last year, the Japanese 40-year government bond, which is it was at the time basically the longest duration instrument on the planet. It had an interest rate of 5 basis points in the summer of last year. And subsequently, if you bought that, you've lost more than 20% of your money, which is what he means by return-free risk. Now, hopefully, our panel can provide us with a rather better ideas for risk return than buying the Japanese 40-year bond at 5 basis points. But starting over on my left here, we've got Bob Kricheff, who manages high-yield portfolios for Shenkman Capital. We've got AJ Murphy, who's the head of global capital markets at Bank of America Merrill Lynch. Andrew Whittaker, who's vice chairman of Jefferies. Anne Walsh, who's assistant CIO for fixed income at Guggenheim. And over on the far right, Scott Evans, who is the CIO for New York City's pension funds, which are the 4th largest in the country. I think the big question at the moment is, should we be going out and taking credit risk or sticking to the supposed and possibly imaginary safety of government bonds? So maybe we can start with Scott from a asset allocation point of view. Should we be piling in at the moment to credit emerging markets, really pushing out the risk spectrum?
So I think that we're living in very interesting times, very unusual times, and fantastic times if you're a borrower. But we are unfortunately a lender, and you know, the price leaves almost no margin for safety in today's environment, and so it's a time to play defense. For a large institutional portfolio like New York City's, and for all large institutional portfolios, we don't have the luxury of heading to shore when the environment doesn't look hospitable. We got to kind of plow through it, and so we stay exposed to asset classes that are thin in terms of the risk premium that they offer, but we're very careful when we do so. In this asset class, the fixed income market, and particularly the fixed income market where there's a risk premium involved, we're very careful and are really on the defensive at the current moment.
And that means sticking more to investment grade, not going so much into the high yield.
On the margin, with the part of our portfolio that is focused mostly on principal protection, so that'd be government bonds and investment grade bonds. We have less investment grade in the government area. We have less duration than we might have in different environments. This is on the margin. You know, I heard somebody saying that the public pension funds play, if you think of American football, between the 48-yard line and the on either side of the ball. We don't change much, but for us it's a fairly extreme movement in terms of the fact that we're a little underexposed to duration, a little underexposed to risk, and that's whether you're in the high yield space, private credit, bank loans, governments, or investment grade, and in all places there are different dials to dial down the risk. But it's not a time to be leading with your front foot in terms of capturing risk premiums.
Okay. And you have the choice, obviously, in fixed income across the space. Are you also pulling back, turning down the risk dials? Or?
Well, like Scott, we tend to view the fixed income markets right now as being less than maybe offering that wonderful value. As I sat here last year at this time, we were just coming off of a very, very opportune time to invest, and so we tended as a panel to be very bullish. But we tend to forget a little bit of history, and I think it might be kind of useful to set the stage. The fixed income market in the U.S. is almost $40 trillion. And so it's not just sort of one big fixed income market. It's a whole lot of different fixed income markets and opportunities. And we've been in the camp that we're in the low interest rate environment for a long time, and that's going to persist. And I came to investments as a career in the early 80s. So my entire paradigm is that we should be at higher rates than we are, and with a lot more spread opportunity involved. But that's not the paradigm we find ourselves in. And there are periods of time in history where interest rates have remained very low for very long time periods, and that persists. Not unlike Japan. I mean, I can remember a few years ago talking about, oh, well, Japan's not going to happen here. And in fact, I think it has. Just as an example, if you go back and look at the 10-year Treasury in terms of history, 10-year Treasury for a period, well, way back, 1878 to 1918 was under 4% the whole time. And it happened again in the World War II period, 1935 to 1955, stayed below 3%. So there's a 20-year time frame there. And we're not really, I think, through this low for long time frame that we've been living in. So we're looking for value in spread sectors that offer opportunity. And like last year in the first quarter, looking for those bumps of moments of volatility to add some additional risk when we do get paid for it. And being very selective within individual sectors to find asset management opportunities for investment for our fixed income clients.
But if you're expecting interest rates to stay low for many, many years to come and for the economy not to fall off a cliff, important caveat, but if you're expecting that, then surely you want to be as far out the risk spectrum as you can be. You should be maxed out in high yield and maxed out in really anything you can, because those spreads can only come down, right? As everyone out there hunts for yield.
Right. Well, so the problem is that markets don't move in straight lines, and so as a result, you do experience moments of volatility, like the first quarter of 2016, and you use those opportunities to add in those, those riskier categories. But I think there's a little bit of a misperception in fixed income that there's only really two ways to pick up yield. It's either to extend duration or to go down to credit quality, and there's actually more ways to think about fixed income. In terms of the credit markets, you can go for structure, liquidity, and not necessarily give up credit rating. Keep a little bit higher credit rating. So for us, that means asset-backed securities within the high-yield spectrum, bank loans, particularly because they have the floating rate aspect to them. And there is a paradigm going on, and that is that the Fed's raising rates. So short-term rates are coming up. And that gives you an opportunity to pick up that additional investment income.
Okay. So Andrew and AJ, great environment for being an issuer. You agree with this? I mean, it's not quite the lowest spreads we've ever had, but it's not far off.
No, it's actually, I think, a really good time to be an issuer. But as I was thinking about, a lot of what you're reading these days about how passive investing is going to take over the world and how everything's going to go to indices and indice investing, I think that that's definitely not going to be the case in the debt side. And Josh Friedman and Steve Tannenbaum yesterday touched on this a little bit. And I think that the CEO of PIMCO mentioned a study where the average active debt investor had outperformed the indices. And I think that was the average one, so a great manager would probably significantly outperform the indices. So as we think about what I would say to a pension fund or an insurance company is, go find a great debt manager in these markets today, which are definitely treacherous, definitely stretched. And great managers are generally, very hard to find, but today they're actually all right here in the audience, so they're going to be very easy to find, and we'd be happy to introduce you to them. I think that for the managers, there are a couple of areas where there is some, relative value. I'm not quite sure there's absolute value, but there's definitely a relative value. We see some value right now in second lien loans. They are generally out-yielding what we would say a comparable unsecured bond by 200 to 300 basis points. You are giving up some liquidity and some call features, but you are moving up. If you're talking about protecting principal and trying to get yield, you are moving up in the capital structure, and you are going to be floating rate. A second area where we see some value today is in small, less liquid new issues of high-yield bonds and leveraged loans. Again, you're giving up liquidity. You have to have a vehicle where you can take the duration risk, where you can you don't want to have an asset-liability mismatch. But we see in the smaller bonds and smaller high-yield deals. So, for instance, we did a study where we showed that tranches of under $300 million versus tranches of over $500 million for comparable bonds, there's some judgment in that, but for what we would say were comparable bonds, there was about 150 to 250 basis point pickup in yield, which is in today's world substantial.
And how does that pickup compare with the pickup in the past? Because presumably it's still less than you might have got as a liquidity premium.
I think it's actually maybe a little bit more today because people are more focused on liquidity. The bonds that every institution in the world will buy. When we first started in the 80s, Drexel was a $100 million bond, then it went to 150, then 250. Now it's really almost $500 million to get a bond that everybody out there, every institution is interested in buying and feels is liquid. So as less institutions are interested in the size of the bond, I think you're getting a bigger pickup in yield. A third area where we're seeing a modest pickup in yield is new issuers, first-time issuers. So first-time issuers in the bond market or the leveraged loan market versus well-known seasoned issuers are getting 100 to 175 basis point premium today. So for an active manager that's going to do the work and meet the management team and vet the business plan and get comfortable with the credit, they're getting paid for their work.
Mm-hmm. Yeah, makes sense, I guess. But again, you're losing that ability to trade on history, losing the reassurance that.
Right. So you have to do your work and do your credit analysis and be comfortable. But if you do it and you're right, you're getting paid for that.
And is there also an index-related issue there that they're not in the index because?
Well, some go right into the index if they're big enough.
Right. Okay. So it's not related. And AJ, do you worry about Cutlight in the loan space? Is that it feels like everything now is Cutlight? Has the quality of issues come down at the same time that the price, as it were, has become less appealing to buyers?
I think the covenant light ship sailed a long time ago. I mean, I think a year or two ago we might have been talking about Europe where there are still covenants. That's largely gone as well. I think the actual maintenance covenant tends not to be the issue. It's really the rest of the underwriting package. So I think it's going to be things like your incremental debt capacity and how levered you can become. Probably more than anything, the most aggressive change to the market has been just the magnitude of adjustments to EBITDA that are being used. I know you probably agree with that.
Yes.
And levered and treated as though they're real EBITDA. I had a senior member of my institution who had been away from high yield for a while, and he was looking at the EBITDA build in a memo, and he said, "But these things haven't happened yet." And I said, "No, but they will, or at least they'll be thought of within at least 2 years." That's pretty aggressive when you're leveraging stuff 6.5 times, but. What we're seeing is if deals are coming to the market and they are of a certain kind of rating and size, and they kind of all go through a pretty similar process in terms of how those covenants packages get put together. And again, I don't think the maintenance covenant in of itself is really the issue, but it is these structures they're pretty aggressive. There's a lot of you see, as you do in other risky markets, the first lien leverage creeping up relative to the junior capital. So I think all of that is pretty aggressive. The other thing, though, that I would say that's you asked, is this a great borrowing environment? And it is, but it has been for a number of years. And we've seen guys fixing long and doing what they're supposed to do for years now. What I think is sort of interesting is that for the well-rated stuff, or even the big stuff, the down the fairway stuff, it's very aggressive. It's very, very tight. For smaller deals, as everybody well knows, there's emerged a giant direct lending source of capital out there. It's probably the fastest growing, the guys who are willing to take some illiquidity to pick up some yield, and they want the scale, right? The scale of the allocation. So, frankly, as I think was said in one of the panels yesterday with one of the private equity guys, we're largely disintermediated in a lot of those junior capital, mid-sized and smaller deals. And if they come our way, there's a lot of adverse selection involved, actually. But where there is a bit of an air pocket, to me, is in the stressed credits. Let's not call them distressed, but stressed. So, there's really, for as much as people are looking for yield, and I think, Ann, you kind of went at this a little bit, the inclination to kind of go down the risk curve, to take that, to take more risk and to do something that may feel a little unnatural for that next 100 or 200 basis points, we're not really seeing that. So I think there's kind of an 8 to 10% air pocket, right? From one stock, maybe 7.5% to there, where for stress credits, and it's hard, and maybe it'll be illiquid, and not everyone's going to buy it. That's a very frustrating thing for issuers who are stressed but not distressed. Like, well, this market's supposed to be so great, and those guys are issuing at L300. Why can't I do something at L400, even though it's a little harder? That market's tough, actually.
But even the triple Cs have come in quite. The spreads on the triple Cs have come in a lot.
Yeah, but there's triple Cs for different reasons, right? I mean, there's formulaic triple Cs, which are probably over levered for now, but are high cash flowing, and the ratings will improve quickly, and they notch into it. And then there are just credits which have challenges, and it's just not intuitive that they're going to work their way out of that quickly. And I think it's very different from pre-crisis, where you could find a buyer for pretty much anything. I'm not sure that's really the case right now.
Right. Okay. Bob, did you want to come in on the broad spreads of? Are you coming in at the bottom of that credit spectrum to pick up the extra?
Yeah, I mean, spreads are definitely tight if you look at it versus historical levels, but they've stayed tight for long periods of time before, and the levered markets have done well. 02 through 07 look very similar to this. You went from 2% growth to 4% growth. You had, I think the 5-year went up about 120 to 150 basis points during that time, and levered debt did great during that time. And so there have been periods, and almost that entire time, spreads were inside of 400 basis points. Now rates were higher, so things were different, but when the economy is doing well, levered credits can do well, even if rates are going up. And when you look at it versus historic spreads, you also have to realize that there's a reason you say historical spreads. They're in the past. Things have changed dramatically in the high yield market. Just post-crisis, double Bs are now about 800 basis points more of the market than they were pre-crisis. So the quality of the market has changed a lot. So there are reasons for the spreads to be tighter versus historical levels. The other thing is you mentioned investment grade, and Ann talked about how diverse the fixed income market is, and the risks in the market you have to define too. The risks are you got to figure out what the risk is that you're worried about in the market when spreads are tight. I would argue that some investment grade names, which you said, are you going there for safety, have more risk than high yield names just because of rates and everything else. So you got to decide what the ramifications are for each risk. I mean, we're number one about preserving capital, so we worry about everything. But the ramifications are. I mean, think about if you have an argument with your spouse or your partner. The ramifications that are very different if you're arguing about whether you should have pizza or Chinese, or whether the landscaper should move in with you. There's just very different. There's a very different take. And so, if you're worried about rates, or if you're worried about credit, or if you're worried about liquidity, each of those risks are very different. And you got to decide where you want to be to get paid for which of those risks are at the highest part of your pyramid.
And which are you worried about?
All of them. We lose sleep over all of them all the time. But I think we feel relatively good about gradual growth in the economy. We think rates are going up, but we think that they'll go up at a reasonable pace. But we are worried about rates moving around. It all depends when you kind of want to start counting the rate clock. I mean, rates are up. The 2-year, post-election moved up 50 basis points in like 2 months, and now it's kind of evened out. So we've had some of the move there. If you're worried about rates, leverage loans are a great place to be now that you're above the LIBOR floor. Short duration strategies, you can get a nice, very healthy yield relative to treasuries or other asset classes with less vol. But we worry about Twitter feeds and geopolitical stuff too, so which can cause some shocks.
So on that 2002 to 2007 spectrum, are we 2004 or are we 2006?
So do we get to break out the credit cycle clock?
Yeah.
I think if 12 o'clock is peak and 3 o'clock is contraction, 6 o'clock is expansion, and 9:30, we're probably at like 9:30ish, I kind of think. But we reserve the right to call for daylight savings time at any moment, and that daylight savings times may come in the form of better growth because of deregulation. There's been a little chat about tax reform here, you may have heard, so it could come in the form of that. But daylight savings time will probably be called from a Twitter account. But we do think that we're at that 9:30 phase right now.
Okay, so you've still got plenty of time to buy, but you should be ready to cash in. You don't want to be locking your money up for a long period.
Yeah, there's still going to be spikes of defaults and spikes of risk. We saw the overall default rate is lower post-crisis than it was pre-crisis, but at the same time we've seen spikes in defaults, and quite frankly the pain for those defaults has become greater. So if you get something wrong in credit, the recoveries for bonds have been worse than they have been in other cycles. So the best defense is proper credit selection, and that's really the best way to fight against risk, is really doing your homework.
Okay. And you're not concerned, I guess all of you, the absolute levels of leverage in the economy. The US corporates now, on some measures, more leveraged than they were before the crisis. In fact, on quite a lot of measures. And some of the smaller companies in particular now, the most leveraged they've ever been. Is anyone concerned? Hands up if you're concerned.
Well, certainly we're concerned about leverage, but at a much lower price point. I mean, they've financed, the corporate America has financed at these extraordinarily low rates for the last number of years. And kind of to the credit clock, I think that, we kind of look at it as like 2005 time frame, maybe 2004, 2005. So, I mean, it feels like a late stage bull market for bonds, but we like to say around the office, bond prices that are up and keep going up are called bull markets, and they keep going, and they tend to persist. And in our view, I think we have more to run. And also to the point about GDP and other effects that are causing stock prices to rise will also positively affect high-yield corporate credit because it's more correlated to equities anyway. So these are late-stage but very positive impacts, I think, for fixed income, in particular for credit, going forward. So I don't think we're not at the point in time now where we have to stop buying credit, but we do, to Bob's point, need to be selective about that credit, and we need to be thoughtful about picking and choosing, and that old word diversification really matters in this particular market. You can't just buy everything and assume the price is going to go up.
And you're not concerned that the hunt for yield is getting out of control? We saw last year. I mean, it wasn't just the Japanese 40-year, but in the equity markets, the bond proxies went to insane levels that then corrected. Is there a concern that just the generalized hunt for yield could at some point really start to go into reverse as the Fed's tightening, and that could have sort of across the board impact on everything?
Well, I think we're not yet to the point of being in the speculative mode. If you think about an investment credit cycle over time, as I said, I think we're in the late stage bull market, but we haven't gotten to speculative. Speculative was 2007 to 2008 timeframe, and when you're really assuming that somebody else has to buy out your holding in order for you to get out or to make money, like the housing crisis, away from bonds but more into housing. You were expecting someone to pay a stupid amount of money for your house. And so we're not there yet, in our view. We have more to run before we get to that point.
Yeah, I don't see a lot of the warning signs of a leverage bubble in the United States. Maybe there's other places in the globe where you can worry about it, but there just hasn't been, any of the signs. I mean, usually you don't see the sign, and you get, as Jamie Dimon said, you get, the bullet hits you from behind,
Big flashing light.
hits you from behind, not from in front. But you're not seeing a ton of triple C issuance. You're seeing some gaming on some of the numbers in some loan deals and stuff, but it's not astronomical. It's within reason. You're not seeing a ton of LBOs getting done, which we tend to believe can be riskier.
You're not seeing a lot of dividend deals. You're not seeing
Yeah.
super holdcos. I mean, there's a lot of really aggressive structures that were created, that increased leverage. And to Ann's point exactly, where the assumption was we're going to continue to see multiple expansion and we can lever our way up to that. And it was all very loan to value. I do think we do see this fundamentally. There's a lot more emphasis, and frankly, the leveraged lending guidelines have helped this on repayment capacity. And I think I think credits are better capitalized, and I think a lot of guys fixed along at low rates.
Yeah, and you're actually starting to see some earnings momentum too. I mean, the S&P 500 this quarter looks like it's going to have double-digit growth in earnings. Some of that's manufactured and played around with, but it looks like it's going to have double-digit earnings growth for the first time, I think, in since 2011 or something like that. So it's probably not that long, but for the last couple of years. So you're starting to see some good momentum from the right companies, and I think that's helping the economy too. I mean, we have our style is to have a lot of contact with companies, and we have like over 3,000 meetings a year with company managements and so on. And you've seen a real change in the mentality of the managements too. If you have a couple hundred meetings in a month and everybody says they're not hiring anybody, you pretty much know the employment numbers aren't going to be good. But now you're starting to hear a lot of these companies come through and talk about capital spending and talk about projects, not just buying another company. So I think that should be good for AJ and Andrew. And so there's other signs that make me less worried about a bubble too.
I'd make the observation that we can never truly understand a bubble, never see a bubble when it's there. They're always clear in hindsight. But we've entered a stage where the extra reward that we're getting for taking risk is on the low side historically. The absolute return, risk-free return, is very low, and without even debating that is going to change much, and it'll change some with the central banks changing their posture. But the real issue is that we're not getting much return for the risk that we're taking. If everything goes right, we'll be fine. We'll get a very modest return for taking a very high degree of risk. This is an asymmetric asset class. We invest with outside managers 100%, so we're not deploying this capital. But I would argue that this is a time that you want someone that has the mentality that Bob mentioned that his firm has. They have trouble sleeping every night, waking up wondering if the people that they've lent money to are going to be capable of paying them back. They worry about default risk. They worry about liquidity risk. Now, we worry less about liquidity risk. We can take liquidity risk. We worry a lot about default risk. And we worry a lot about underwriting standards, the leverage that's creeping in. I mean, the percentage of covenant light now is much higher than it was at the peak of 2006, 2007. The leverage ratios in high yield now are getting to be at very high levels, the multiples of EBITDA. It's time to play defense if you're an asset allocator. And the other thing that we do is we give capital to put it in strong hands that have solid underwriting standards, and we let them try to find the pockets in the market where you get good risk return, where we can deploy our ability to take liquidity risk effectively without sacrificing confidence, without sacrificing risk premium. Getting that in size is difficult, and we're all trying to find the same thing. But on the margin, we will opt to get our money back rather than to get that last ounce of yield, and it's a time to be defensive.
Is it at the time when you're perfectly reasonably saying this is the time to play defense, if you're small and nimble, is that the time to be saying, well, I want to get in, I want to be in a bubble. Bubbles are great. Bubbles are when you make really big money. So you want to get in now, hope that there's a bubble, pray that there's a bubble, and then get out in time.
God bless them. It'll be a different group the next time.
Yeah, very reasonable.
Scott, do you think some of your peers elsewhere are getting more aggressive? Do you think you're in the minority or the majority there?
I don't know. I mean, you can't. I mean, when you look at the behavior of the market, you look at the erosion of underwriting standards, you look at the increased leverage that's coming into the market, you look at the preponderance of direct loan providers in the market today. Somebody's getting more aggressive. It's the only way that the prices could get to the place that they're in. Now, unfortunately for me, they're aggressive in high yield, they're aggressive in bank loans, they're aggressive in direct lending, they're aggressive in U.S. equity and in international equity and infrastructure and real estate. And so this is a period of time where there's not much risk premium in the market in any asset class. But yes, we're forced to take risk as a group of investors. There's too much capital floating around. And this has never ended well when you've had this circumstance. And it may be some time from now that the trouble starts. But I'm going to be hiring defensive managers and giving them room to give capital back. One of the things we have in our separately managed accounts in the alternative credit spaces, you give us the money back. And it's an evergreen structure. When you see opportunities again, you can take it down. Some of our better managers have used that and actually have a lot of dry powder. And the money's sitting in less riskier places until we get paid for taking risk.
And I do think, to your question about who's being aggressive, I looked at an allocation of a bond we did recently that was in the low sevens, which is a hard thing to find these days. And actually, what surprised me was a pretty solid number of the orders, not the allocations, but the orders were hedge funds that I hadn't heard of. And I had not seen that.
That you actually hadn't heard of.
I had not heard. I'm not going to name them, but no, I mean, which was a little bit reminiscent, right, of the 06, 07 time frame. And you have to imagine that they're looking for yield like everybody else, but that was a little bit of an eye opener. And again, it's not how we allocated it, but it was just interesting. But it was interesting to see how many new entrants there were. Yep. And that's not to suggest that all those guys are quick money, but you have to be a little careful when you see that, I think.
Yep.
Have any of your colleagues on the structured credit side suggested creating a new CDO?
No comment.
No. Okay. Just like, I suppose the interesting question is there a thing we should be watching for that tells us that there is absolutely, undoubtedly, way too much excess out there? So back in 2007, it was the CDO squareds. Is there something similar now that is something that's really pushing the limits of what's acceptable?
Well, I don't think there's necessarily a new structure, but the CLO formation right now is very, very significant, and it's creating a structural imbalance in the first lien loan market where there's just much more demand than there is supply, and most of the supply has just been repricings, a lot of which has now gotten done. And when you talk about how long this might last, not to be defensive, I think you're right to be defensive, but I think the companies did learn in the last crisis that liquidity is king. You better have some liquidity to last a short, illiquid piece of the market. And I think people have definitely lengthened maturities. The average maturity is much longer now. So that if there is an issue, they'll be able to get through it. But the flip side of that is the markets now are so big. Between the high yield and leveraged loan market, it's like $2.5 trillion. So if there's a problem and there's a big default spike, a 10% default rate is not, unusual in cycles. You're going to have a $250 billion issue. So it's going to be a big, big problem if there is an issue.
But does that mean does the extension of maturities mean we just can't see a big problem of that scale because it would have to be staggered out over a series of years as the maturities came through? Well,
potentially. I mean, in the past, there wasn't as much covenant light, so when there was stress in the system, the covenants would kick in, and so you would have a little early warning system. Now, with the covenant light, you're going to find out there's a problem when they don't pay the interest. Right. And so that's going to be, make for, lower, as you were talking about, lower recoveries, and, a bigger problem when it does hit.
And
Well, that's why corporate disclosure and staying on top of these companies is so important. So even if you don't have the covenants to protect you, if you're monitoring these names day in and day out, and they allow you to monitor them, with proper public information and everything, you don't get surprised when they don't have to pay interest. So it comes down to, covenants can protect you to some extent. And I'm a big fan of covenants. Don't get me wrong. Keep them in there, guys. Put them back in there, I should say. But you still have to get the credit work right to protect yourself, because the company doesn't want to go into default either. Ideally, they would rather not, but sometimes it gets out of their hand. The covenants are frustrating and struggling, but it's also one of those things that happens in these cycles, and the covey lights have been getting lighter and lighter.
But most of these credits are bigger, right? So if you think about pre-crisis, and the covenant was sort of the warning flag, but now it seems as though with a vast number of the credits in the market, they're much better followed, they're larger, they're more liquid, and there's fewer names that pop up that you don't know and you didn't know something was going on. The disclosure's better.
Yeah, no, I mean, exactly. I think I would get really worried if some of these disclosure covenants started to disappear.
I agree.
And with the private companies. But more of the companies are public now than they've ever been. The companies do tend to be larger. There still are the 250, 300 million ones. And it's usually the private ones that you're more worried about the disclosures with. And quite frankly, often the sponsor-driven companies that are private have different views on how much disclosure to give. And so, but you're absolutely right. The general market is, just as the ratings quality has improved, the size and the disclosure has improved too, which means the ones that go bad hard.
Right.
do you think there's a lot of people who are out there buying who are, I suppose, who've never really lived through a cycle? I mean, obviously our panel's very experienced, but...
Not with anybody here. There are people running trading desks
Yeah.
around the world that have never seen a rising rate interest rate environment. They've never seen a default.
Yeah. I mean, we've had such low defaults for the last 8 years. Yeah. Are we now at risk that when we do start to see a perfectly normal cycle, that actually people are going to be shocked and you might get a much bigger reaction to it?
Well, you might see that, in the ETFs and the index funds, because a lot of people are just putting money into that. They literally are buying blind and not monitoring and not active management. And so some of those investors might be surprised, and that might cause a little bit of a step function in the market potentially. And
are the ETFs and the index funds in general starting to influence pricing in the market? Because you kind of know you can issue because they're so big that they're going to buy it anyway.
Well, again, they're only buying the very, very large issue. So yeah, if you have a large issue coming, you can pretty much be assured everyone's going to want to have it because it's going to be in the index and they want to be able to follow the index.
Yeah, but from when you're working for these companies doing the issue, are they actually thinking like that?
I think in general, people would like to, if they can do a big enough bond to get it into the index, I think they would definitely like to do that. It helps.
Okay.
Well, to Scott's earlier point, the next cycle isn't going to look like the last cycle. And, the question of the fact that there may be, and there is, covenant light and the underlying asset class in bank loans has some potential risk issues developing, certainly. There are structural changes that took place in the structured credit market post-crisis. There were a lot of legacy investors that aren't in that market anymore. There is a size, it is larger, but there has been risk retention, there has been structural change in terms of issuance. I think CDO squared is not coming back, and if it does, there's a sign. There's your canary in the coal mine.
I tell you, I'll be writing about it.
Exactly, that'll be the day. I'll be, okay, that's it, I'm out. But in the meantime, there's still a lot of value there, and that goes back to structure. And we talk a lot in our office about crisis at maturity. That the idea that something's you're not going to get a sign it's happening until it happens, and it doesn't make the interest payment or it defaults. And as a portfolio manager, one of the elements of liquidity that we tend to forget is that portfolios can be constructed in a way that they are maybe self-amortizing, or that they're sources of liquidity other than actually having to find a buyer for that asset. So we think a lot about actually having cash flows that come into the portfolio, and we like asset-backed and structured securities for that purpose, because you're not relying on on that, as I said, on that next buyer or that liquidity opportunity. And Andrew, to your point about ETFs, there's also a lot of cash sitting around. So one of the other reasons that we tend to think that we're not exactly at the end of this cycle, that there's still more price appreciation to occur, is because there's still a lot of investors out there, and we haven't even talked about non-U.S. investors coming into the U.S. market. There's still a lot of buyers out there pushing prices up that we can see over the next few years, to the extent that we don't have a big default event. And then we did have a little mini default event with energy. And so for those young traders out there, they got to see a little bit of it in non-investment grade, and we certainly got to see investment grade credit slide into non-investment grade. People are a little bit tense about that, and will that continue or spread like into retail or other areas? So I think that again, goes back to the point where we're picking your individual sectors and your securities, and then adding that diversification really makes a big difference, because, and Scott, I sympathize with the large asset pool that you have. Moving a big ship at the time, not really is able to be nimble, and move an entire portfolio at precisely that moment in time when that canary in the coal mine happens. So you do have to be really thoughtful.
Yeah, the little default cycle and all the cash sitting around is kind of interesting that we had. I'm sure for some people it didn't feel that little, the default cycle. but I think it's almost like, what doesn't kill you makes you stronger, the high yield market. Every time we seem to get hit, whether it was the 08-09 crisis, even 2011 when we almost shut the country down and we got downgraded in the US, and Europe was having a little grease problem, which they do every 3 years. And then even the taper tantrum, and then the energy and commodity blow up. Each time the market comes back, it seems like some new pool of investors say, oh, it's a real asset class. It's safe. I can come in. And so it does feel like each time you go through one of these things, that people kind of are marvel at the strength of the asset class, that it can come back. And I'm talking broadly levered credit in general, because the bulk of the name, there's a lot of really good names in there, a lot of really good companies. The key is not buying the ones that aren't. but the bulk of it is a strong market.
But they may be good companies. I mean, although obviously poor credit relatively, but they're still offering. I mean, I looked this morning, and you're getting 5.7% on high yield, which, if you said to Michael Milken that you were going to have a high yield bond with 5.7%, he might say, well, it's junk, but it's not high yield. That just isn't high.
Everything in life is relative. The German Bund is negative, so
right.
So it's odd for me, but it's the world we're in right now. So, but I mean, it's part of Scott's frustration that he said that, are you getting paid enough?
Yep. It's the spread, right? So the base, the risk-free return is much less, so the nominal rates are lower, but the spread is not at its lowest point in history, but it's close enough to worry.
Yeah. Okay. And what would make you, or let's say it differently, where are investors most out over their skis? So emerging markets, you've made about 1% a month in EM local currency bonds this year, which is a pretty phenomenal return, frankly. You've done really quite well in junk. What's the area of the market which is worse, or are they just all the same, all very extended?
What's the error in the market?
Well, so I mean, you've got euro.
You mean what's the most
US.
overpriced part of the market?
Yeah, exactly. Where are investors most out over their skis?
Yeah, I think you're talking in debt or in all?
In debt, I guess, but also, I mean, if you've got some other things you want to highlight,
we don't
people will be
participate in emerging market debt, so I can't comment on that. And we really don't do much non-dollar debt, so I'm probably not a good person on that. But in the public space, the yields have gotten bid down really, really aggressively. In the private space, there's still pockets of opportunity, out of the way places where there are not a lot of folks that managers can access. You have to be very, very careful that you're with the right person when you're hunting in that area, particularly with the crowd of managers that's there today. I think they're reasonable opportunities. We're staying invested, but we're not pouring in to the asset class.
Is there anything you absolutely wouldn't buy, Anne, because it's just way too? What is it? Tell us.
All right, you'll find this maybe a little bit unexpected, but U.S. agency mortgage-backed securities are the most overpriced part of the market. historically and on a relative basis. There's been one large buyer, and as the Fed decides to unwind its balance sheet sometime potentially in the second half of this year, we might see some actual repricing going on. But we find that there's probably a little bit of value in lots of other places, and maybe in some areas more than a small amount. We still like structured credit, as I've mentioned, asset-backed securities, and some areas of non-investment grade, particularly bank loans. But the area that we have literally stayed away from for now months and months is agency RMBS.
I totally agree with that. I mean, we have radically reduced our exposure to that, but it's a subsidized market, and it's going to get unsubsidized when the Fed unwinds its balance sheet, and so you're not getting paid at all to play in that part of the market, and we've radically reduced our exposure.
So that's your real risk, return-free risk, isn't it?
Yeah.
But when the Fed pulls out, will that not have knock-on impacts on lots of other things? I mean, you say to U.S. householders, "I'm sorry, your new mortgage, if you want to remortgage, it's going to cost you more." You're going to see a collapse in remortgaging, obviously, but you're also going to find that new buyers are facing pressure, and that tends to have ripple effects on the whole economy. Would that, do you see a knock-on effect that you worry about there, or is that just part of the tightening cycle?
I'm a little bit more, I'm taking a bit more of a wait-and-see attitude, I think, towards the Fed unwinding its balance sheet. Our expectation is that they're not going to suddenly sell assets. They're simply going to let them migrate off, and in which case the effect will be more subtle. And by not reinvesting, however, into mortgages, I think we'll see a return to a more, there's your normalized market potentially. The other thing is that, again, going back to the point that the last cycle is not going to be the next cycle, it's probably not going to be in housing. And given the change in underwriting that's been taking place and has taken place post-crisis, I'm not as concerned about the underlying fundamentals of that asset class as so much the market pricing. So I think the knock-on effect will maybe be a little bit less impactful if it's gradual.
Any concerns? You, Bob, worried about that?
I see some concern about the, whatever you want to call it, the direct lending, the private lending market. I think people have to be very selective there, and there's probably some warning signs just of it becoming very bit of a crowded trade. There's a recent report by a firm that actually benefits by that market growing, talking about how there's more dry powder chasing deals in that market than there's ever been before. There's more use of the unitranche type of transactions, which can make a portfolio look artificially like it has first liens to some extent. And I think there's some operators out there that do a great job and will continue to do a great job in it, but I think it's an asset class I think that people have to be careful with. And also to a point I made earlier, it's an asset class where 70 to 80% of these portfolios are all coming from deals, from private equity type of sponsor deals. So, how aggressive, if they're getting all their supply from 2 or 3 sponsors, how aggressive are they going to be on a restructuring in any given name? So I think it's an area that has a lot of potential. A lot of people have been interested in it, but I think you have to approach it with great caution. That yield sign is actually like a yield like warning kind of sign as you're merging into traffic when you go there.
Okay. And
I think on the emerging market side, you really have to have a view on the dollar for most of the people in this room. So if you think the dollar is going to be strong, which I think is, we believe has some room to run, then you have to be very careful in the emerging markets unless you're buying commodity-based dollar revenue type companies.
Isn't that a bit of a 2016 view that we'd have a strong dollar? I mean, it's everyone seems to have given up on the dollar this year.
If you think the earnings are getting better and the economy's getting better here and rates are going up, dollar's likely to go up.
Yeah, but I mean, if that was happening, I mean, the 10-year this morning was at 2.31%, the 10-year Treasury. I mean, if people think rates are going up, why is that happening? Why? I mean, the market doesn't seem to be broadly saying, yeah, this is going to happen.
I think right now there's been, and again, it gets back to the geopolitical. I think there's been a little bit of a sell-off or a buying rather in the lowering of the long-term rates as people see the politics in the country going a little slower than maybe they had hoped. So I think baked into a lot of this is that something will get done on the political front. Maybe not everything that's been proposed, but something gets done. I think if nothing gets done all year, then that might have a different effect on the dollar. But to the extent the economy is growing and there's some progress on the political front, I think there's a very good chance the dollar will go up.
Yeah. But then you've also got I mean, we've seen in the first quarter, it looks like Europe's going to be growing at least as fast as the US, if not faster. The ECB is maintaining its dovish position, but pretty much everyone expects them to pull back from that at the end of the year.
Right. Well, I'm thinking more like the trade-weighted dollar as opposed to just the euro. I think actually in Europe right now there are, again, you have to be very careful and selective about it, but there are some high-yield bonds that are definitely interesting and provide some relative value, again, depending on your view of the dollar.
But is that buying the... I guess it's more investment grade, but it feels like the high yield yields have been pulled down a lot in Europe because the ECB has been hoovering up everything it can in the investment grade and the top bit of the crossover space. Right.
Yeah. Again, I think you have to be careful and you have to pick out the right credits, but more in the single B area.
Yeah. Okay.
I think you make a good point about European high yield. I mean, obviously that's a very technical trade that's running through that market. And I think what's interesting is as European high yield has grown dramatically, I think it was a couple of years ago that we saw for the first time, even yields and even spreads. And that really assumes that there's a comparable liquidity profile to European bonds that there is to US bonds. And I think there's a lot of risk in assuming that. I think that's a market that we've seen that when there's a correction, it corrects much, much harder. I think the number of independent viewed players in that market, guys who aren't going to all kind of, jump onto the same trade when things go south, I think that's enormously risky. I also think that there's a fair number of players in that market who went to Europe post-crisis thinking all the banks were going to shed assets and there was going to be all these great deals to be had, and that never really materialized. The local banks sort of bailed a lot of these companies out, and some uneconomic things happened out of nationalism and this and that, and now you have the ECB. I think that if there's a market to be a little bit careful of, I think European high yield is trading, I think, way too tight to the dollar market when you look at how those two markets stack up liquidity-wise.
Yeah, I'll play a little devil's advocate with you there. I definitely agree that the market, the investor base, is not nearly as diverse as here. You're totally right. I think there's much more. They tend to move student body left, student body right. I will say that the market is much more diversified. The actual credits in the market are much more diversified than they were, pre-crisis or any other cycle you want to go through.
It's still what percent of it is cable?
Oh, yeah, but it used to be like 60% cable and telecom. Now it's like 10 or 15%, and finance is 10 or 15%. So it's certainly not as diversified as you'd like to be, but it's better than it's been. But I do agree there's huge pockets of it that are way overpriced right now because there are the same buyers going after the same names. Now that also creates some opportunities, but I think you have to be really selective. If you look at spreads on a single, the market's so much more heavily double B over there. On a single B basis, the spreads are actually not that bad after you currency swap it and everything. So I think there are selective opportunities in single Bs where you can pick up. And there's sometimes, US dollar, European R by the same issuer if the issue is not that known. But a lot of it is very, very tightly priced. But the market has improved a lot from what it was, though. I would say it used to be like a club, and now it's at least the market.
Yeah, I think it's much better than it was. I just think that there, particularly in the double B space, there are just some incredibly tight names over there that could move pretty quickly.
Oh yeah, and some of your issuers have taken advantage of that.
They have, yes.
Do you actually see people manipulating their issue in Europe, especially to be eligible for the ECB? So
they're encouraged to do that. I mean, the ECB actively encourages issuers to seek out, to fit the parameters. So I wouldn't call it manipulating, but yes, I think that they're approached and said, here's how you make it fit into the bucket, and so they do.
Okay.
Yeah.
That seems kind of a bit much financial engineering. Yeah. Okay. So we've got 5 minutes left. Should we just go through what you see as the biggest risk out there? Is it endogenous? Is it that investors just get way overdone? Or is it something fundamental, politics or economics? Where's the risk? Let's start with Bob.
You ask me where's the greatest risk again? It's I'll say it's everywhere again, because everything looks too too calm and too steady as she goes. But I think there's probably risk. There's certainly risk in some sectors. I think industry sectors, if you want to think verticals or however you want to think about it. An obvious one is retail. I think that everybody's concerned about. It's going through massive changes. It's right in the target of a lot of the technology that's developing. There's some opportunities in there. There's still some businesses that can do very well that are unique. But I think some of the risks are going to be, I think some of the near-term risks are going to be a little bit more of that micro type of risk than maybe all the macro ones that we're looking for.
Okay.
I guess I would say if there was a particularly large bubble in terms of M&A and a bunch of large deals being put on at the same time, because there's a little bit of a sanguine attitude towards large deals, and those that we've seen have gone pretty well. But I think that one of the biggest drivers, other than low rates of our market, has been the lack of volume, certainly new dollar volume. And so I think if that picture changed quickly, we've seen that happen a few times in the last few years where that kind of puts the brake on the machine. So I think that's just something to keep an eye on.
I think if there's some liquidity event that causes a problem with an ETF, either on the loan side or on the bond side, and people realize that they might not be quite as liquid as people like to think they are, and the holders of those securities, who a lot of them are retail, decide now's the time to get out all at once, that kind of a liquidity event could cause a problem in the market for sure.
That certainly seems to be the thing the regulators are most concerned about,
right.
At the moment when I talk to them at least.
So for about the last 8 years, I think we've all been Fed watchers, and that's pretty much been the entire thing that we've done. Post-election, now we're looking at fiscal policy, obviously potential global impacts. So from a macro view, I think our concern would be that there was to Andrew's point, a liquidity event or a volatility event, which tends to be seasonally during the summertime. And it appears that we may still have some news coming out of Europe, not yet determined. But as we come into the seasonal volatility, we're cautiously looking at the market. We're hoping for an event where we can buy in cheaper, but the risk is that during the summer we could see some real significant volatility, and it could drive a liquidity event. But I agree with Andrew. I don't think that the ETF risk is very small. I think it is there.
I think these are all good risks to worry about that are local to this market. I'm struck at this moment by the lack of geopolitical risk premium that's in the markets. We're living in a period of time where we may be going through a rather large regime shift in the way that the world is ordered, the financial consequences of which are rather uncertain. And I'm struck by the fact that there's almost no risk premium for it at all in any asset class. Unless you're investing in Venezuela or Russia, there's a good risk premium there. But I find that striking, and I think it's something to worry about, not just for these asset classes, but for all asset classes.
Well, we'll see the French election on Sunday, so let's hope that doesn't derail.
Certainly a pivotal event.
Yeah. Okay. Well, we're right bang on time. So thank you very much to the panel, and thank you all for coming.